South Africa's bond market rally is gathering pace. That's as yields on longer-dated government bonds head towards levels not seen in nearly a decade. The 30-year yield has fallen sharply from its 2023 peak of 12.7% to 8.6%, while the 20-year has dropped to a 10-year low of 8.5%. The benchmark 10-year bond is hovering just under 8% and could fall to 7.5% this year. The decline means government is borrowing more cheaply, which is easing pressure on debt servicing costs, which currently top 386 billion rand a year. Analysts say improved fiscal discipline, a lower inflation target, a stronger rand and last year's credit rating upgrade are all boosting investor confidence, with further interest rate cuts still expected this year. Telkom says its data-led strategy is paying off. The mobile operator has reported a near 10% climb in third-quarter data revenue, with that income stream now contributing 60% of total group revenue. Mobile subscribers have now topped 25 million, with data users surging nearly 30%. CEO Serame Taukobong says the disciplined execution of Telkom's data-led strategy and cost optimization efforts are strengthening the firm's position as South Africa's digital backbone. AECI expects a sharp jump in full-year earnings. The Explosives and Chemicals Group says headline earnings per share could rise between 43 and 58%. It's attributed stronger underlying profitability and an improved operational performance at its mining division as drivers for that growth. The firm has also indicated that net debt has been slashed from 3.7 billion rands to just 460 million rands. That's after 2.3 billion rands in disposal proceeds were used to strengthen the balance sheet. AECI will release its annual results on February the 25th. Atbid is moving ahead with its push to acquire controlling interest in RMB Holdings. It snapped up over 44 million additional shares over the past week. The purchases, made both on and off market at 47 cents a share, now brings the Atterbury Property Fund's total holding to just over 32% of RMH's issued shares. The group says these acquisitions have been fully disclosed to the Takeover Regulation Panel, and it may continue to buy more RMH shares during the offer period. Further afield, Japan's economy limped back to meager growth in the fourth quarter, significantly missing market expectations in a key test for Prime Minister Sanai Takaichi's government as cost of living pressures drag on confidence and domestic demand. Let's take a look at this report for more.
Japan's economy struggled to fire up during the fourth quarter. It posted only weak growth and missed market expectations by a wide margin. Government data showed Monday gross domestic product rose 0.2% on the year in the October to December quarter. That was well short of an average 1.6% expected by analysts. It also meant a 0.1% quarterly rise, again below market expectations. It presents Prime Minister Sanai Takaichi's government with a key test as it tries to deal with cost of living pressures. Takaichi recently swept to a convincing electoral victory. Her administration has pledged to ramp up investment through targeted public spending. But Monday's data shows the challenges faced by policymakers, especially at a time when the Bank of Japan has held its pledge to keep raising interest rates. The central bank has further said it will normalise monetary settings after years of ultra-low borrowing costs due to inflation and a weak yen. Private consumption makes up more than half of Japan's economic output. It only rose 0.1% in October to December, cooling from the previous quarter's number. It implied high food costs are still a drag on household spending. Investors will look out for Takaichi's campaign pledge to suspend a consumption tax. The issue led to turmoil in Japanese markets, with investors worried about fiscal problems in a country with the heaviest debt burden in the developed world. Analysts project Japan will continue to expand at a gradual pace this year, though the fourth quarter's weakness suggests the economy might struggle to improve quickly.